Hey everyone, welcome back to Corporate Decoder, the place where we break down corporate earnings reports so you can understand exactly what's going on behind the scenes and maybe make a quick buck. Today we're diving into the Callodine Specialty Income Fund's latest prospectus. They're offering different classes of shares and are promising high current income by investing in a bunch of different credit opportunities. But what does that really mean for your money? Let's decode it, and hey, if you love getting straight talk about company financials, make sure you're subscribed. We also have a Discord community linked in the description where we discuss these things in more detail. So what's the deal with this fund? Callodine Specialty Income Fund is a new player, organised in July 2024. They're an interval fund, which basically means they offer a limited way to buy and sell shares, not daily, like a typical mutual fund. Think of it as a slightly more exclusive club for investors. They're managed by Callodine Capital Management LP, and they're planning to invest in things like asset-based lending, real estate lending, life sciences finance, direct lending, high-yield debt, and yielding equity securities. They're using a multi-strategy approach, which means they're spreading their bets across different types of investments, hoping to reduce risk. Now let's talk about the cost. This is where things get interesting. For Class I shares, the total annual operating expenses are 4.08%. For Class A shares, it jumps to 4.33%, and for Class C shares, it's a hefty 5.08%. This means for every $1,000 you invest, you're paying around $41 to $50 each year just in fees. That's a significant chunk, especially when you consider they're also charging an investment advisory fee of 1.35% and an incentive fee of $1.350 each year just in fees. That's a significant chunk, especially when you consider they're also charging an investment advisory fee of $1.35 to $50 each report, 30 euros each year just in fees. That's a significant chunk, especially when you consider they're also charging an investment advisory fee of 1.35% and an incentive fee of 1.41%. The total annual fund operating expenses after fee waivers and reimbursements illustrate the ongoing cost of managing your money. The examples here are quite telling. For Class I shares, investing $1,000 and assuming a 5% annual return, you'd pay about $51 in the first year, $142 over 3 years, and $497 over 10 years. Now for Class A shares with that upfront 5.75% sales charge, you're looking at N888 in the first year, $1987 in 10 years, even Class C shares $19 over 3 years, and a whopping $543 over 10 years. Even Class C shares with that upfront 5.75% sales charge, you're looking at 188 in the first year, $98 over 3 years, and a whopping $543 over 10 years. Even Class C shares with that upfront 5.75% sales charge, you're looking at 108 ADS in the first year. What that upfront 5.75% sales charge? You're looking at $143 over 10 years. Even Class C shares with that 1.0% distributions and service fee cost you $71 a year. Now about liquidity. Being an interval fund means you can't just sell your shares whenever you want. They plan to offer to buy back shares quarterly, but only a portion, between 5% and 25% of outstanding shares. And if more people want to sell than they can buy, you might only get a part of your money back or have to wait. Plus, they're not listing shares on any exchange, so don't expect an easy way to sell. You should think of this as a long-term, somewhat illiquid investment. They expect their first repurchase offer to kick off in the third quarter after they start operations. The fund is managed by Callodine Capital Management LP, and they're bringing in several sub-advisors to handle specific strategies. These include Callodine Credit Management LLC, Thoroughfare LLC, Rand Capital Management LLC, and Manning and Napier Advisors LLC. It's interesting to note that these sub-advisors are author affiliates of the main investment advisor. This setup can sometimes create conflicts of interest, as they're all part of the same corporate family. Let's look at the key people behind the fund. James Morrow, the founder and CIO of Callodine Capital Management, is a co-portfolio manager. He spent over 19 years at Fidelity managing billions. Gene Martin, co-portfolio manager, leads the asset-based lending strategy and has over 31 years of experience in credit markets. Then you have Winston Black for life sciences finance, and Scott Barfield and Stephen Brannan for direct lending, and Brendan Miller and Kevin Miller for real estate lending. Mark Bushelo handles high yield debt, all with impressive pedigrees. The fine print also mentions that the investment advisor and its affiliates might pay third parties to help distribute shares. While these payments come from the advisor's own assets, they state the amount could be significant and might give those third parties an incentive to push Callodine's fund over others. This is a common practice, but something investors should be aware of. Tax-wise, the fund aims to qualify as a regulated investment company, or RICE. This means they generally won't pay corporate taxes if they distribute most of their income to shareholders. To do this, they have to meet strict income and asset diversification requirements. Failure to do so could mean paying taxes at the corporate level, which would hit investor returns. Now for the risks, there are quite a few. They explicitly mention cybersecurity risk, noting that recent years have seen a significant increase in these threats. A breach could lead to losses, damage to reputation, and legal troubles. They also point out operational risks, which are basically the chances of things going wrong due to processing errors, human mistakes, or system failures. It sounds like they're taking these seriously, but it's good to know these are on their radar. Something important to remember is that the fund was only organised in July 2024, and as of the prospectus date, it hadn't even started operations. This means there's no history to look at for performance. They're also not obligated to raise a specific amount of capital, so there's a risk they might not gather enough to be profitable or meet their objectives. If they don't raise enough, shareholders could end up paying higher fees due to a lack of scale. Looking at the portfolio manager's other accounts, we see a bit of a mixed bag. For James Morrow, he manages one registered investment company with about $119 million. For Gene Martin, he manages two other pooled investment vehicles with around $455 million. Mark Bushello manages 9 registered investment companies totaling over $3 billion. Scott Barfield and Stephen Brannan manage 2 pooled vehicles each, with the Millers managing about $78 million each. This shows a breadth of experience, but also how spread thin these managers might be. 1119 Miller also managed 2 pooled vehicles each, with the Millers managing about $78 million each. This shows a breadth of experience, but also how spread thin these managers might be. On proxy voting, it's interesting that their sub-advisors have different approaches. Callodine Credit Management and Thoroughfare, for example, rarely vote proxies due to their investment strategy, but they have policies in place if they do. Ram Capital Management also notes a limited number of public equity holdings, and Manning and Napier will vote with Glass Lewis recommendations or defer to their analyst. This shows a layered approach to governance, but the lack of active proxy voting by some could be something to watch. The financial statements for the interim period ending May 31, 2025 showed total assets of $715,312. With cash being $100,000, liabilities are around $608,000, resulting in net assets of $107, suggests the advisor is fronting a lot of the initial setup costs, which is common. And looking at the schedule of investments as of May 31, 2025, the fund has made some investments. They're primarily in senior secured loans, with about 31.93% in healthcare, like Daria Health Corp, and 66.1% in industrials, like Barry GP Durr. Total investments cost about $13.7 million. This shows a small but invested portfolio, with the majority in secured loans. So what's my take on Callodine Specialty Income Fund? They're bringing serious expertise to the table with their investment managers, and their multi-strategy approach could offer some diversification. However, the multiple layers of fees are a significant consideration, and investors need to be comfortable with the limited liquidity of an interval fund. The fact that they're a new fund with no operating history adds another layer of risk. The significant coverage of potential conflicts of interest and operational and cybersecurity risks in their filings suggests they're aware of the challenges. For investors seeking high current income and willing to tolerate less liquidity and higher fees, it might be worth a look, but tread carefully. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out our Discord in the description to join the conversation. Thanks for watching. See you next time.